I'm Rhonda Schapfer with The Deal. Here to take a look at M&A activity in 2017 is Mark Gerstein, Global Chair of M&A with Latham and Watkins. Nice to see you here.
Good to see you as well.
Will we have momentum going into 2017?
Well, I think to answer that question, you have to take a step back and look at the drivers in 2016. And I think those were principally sort of the thirst for growth in earnings, consolidation in difficult segments, China. I always feel like Tim Russert, China. And finally, the transformational acquisition. And if you go back to the top on that, we saw an enormous amount of activity amongst our clients looking to grow earnings in what is otherwise a low growth GDP environment, and even more so obviously in our European clients. Whether it was trying to acquire earnings in a better valued currency, or an effort simply to grow into new markets, or reposition the company, generally speaking, with product lines. The push was there to do that principally because they're not finding earnings growth organically in the markets. If you then look at 2017 going forward, it's hard to see many of those factors changing. I think you're going to continue to see consolidation industry like metals and mining, oil and gas, where a floor, at least on the oil and gas side, has been put in place to enable people to thoughtfully combine companies. And the mining and metals industries just have to combine to reduce costs given the pricing of commodities and the reduction in demand in China. And ultimately, I think as a consequence, you'll see the momentum generally maintained. The one limitation I'd say is there is political risk in the environment. And it's not sort of a Clinton-Trump political risk so much as I think is this rise of nationalism occurring both in the US and in Europe. And when that nationalism arises, you have to worry that national investment review will become a proxy for political issues. That antitrust review will become a proxy for some of the income inequality or anti-business issues. And those could become a significant drag going forward depending on how I think the regulators react to their own country's politics.
Clearly something to watch. What about deal valuations? How do you see that evolving in 2017?
Valuations have remained relatively high because the stock markets remain relatively high. And historically, strong stock market has led to strong M&A activity. I think for strategics, it's not that much of an issue between the low cost of debt and the fact many of them using stock as a currency in their transactions, that they can continue to purchase into these valuations. I don't see the M&A valuations going much higher except in relationship to the equity markets generally. I think where it's really challenging a segment of the M&A market is private equity, where they're using cash and even the low cost of debt doesn't overcome the high valuations in the companies they're targeting. The one place where you might see a little bit of a retreat is those sectors where normally you see an IPO exit. And if that window remains closed or only narrowly open, I expect some of the companies that were going to look to take an IPO exit and otherwise hitting a finance wall will start selling, and there'll be a little more pressure on those prices.
What about regionally, especially in light of what you said a bit ago about nationalism?
So I think if you look at Europe, for example, I think you'll continue to see outbound M&A from Europe. Those markets seem meaningfully behind ours in terms of recovery. They weren't helped by the Brexit vote. As a consequence, those companies need to buy growth simply by moving into other high growth markets. And I think that'll principally be the United States as Asia slows. US outbound activity, I think, will continue at the current pace. Again, pricing's a little less expensive in Europe than it is here. So if a company's looking to expand either by product line or simply for scale, it's going to be a little cheaper to do that in Europe. Britain seems to be a little bit on sale. I think M&A activity was up 200%, quarter 16 versus third quarter 15. And I think you'll continue to see China actively entering all these markets, whether it's a combination of attractive pricing for them in Europe, a desire to move currency offshore, or simply a set of national goals to push towards expanding their footprint and buy brands.
Mark, what about the role of activist investors in driving M&A?
I think you have to take a step back on activism and define what it is these days. Activism is no longer simply an asset class. It's just an attitude among all institutional investors. And as a consequence, there's been both a proactive and reactive reaction to the activist agenda. The boards of directors we work with are constantly focusing on the portfolio of businesses they have with an eye towards whether they might hear something from an activist about it or frankly are just a little more disciplined. And those active boards have changed management's perspective as well. So I think substantial organic change, reshuffling the portfolio the way, for example, Emerson or Delphi has recently done to higher margin products, will continue. And I think, if anything, the activist environment has really just changed the attitude with investors generally at the board level and with management as a consequence. I think companies are just more inclined to M&A, more willing to take a little more risk on M&A, and more willing to pull the trigger on divestitures to reposition their margins and their product lines for the equity markets.
Mark Gerstein, I've enjoyed listening to your outlook. Thanks.
Pleasure talking with you as well.
I'm Rhonda Schaffler with The Deal.